Good afternoon, everyone. I'm happy to introduce you to our next session, U.S. Equity Market, an in-depth analysis of zero commission model. To give you more insight, please welcome Michael Lombardo, Head of Global Equities at Tradeview Markets. Michael, the floor is yours.
Jeff, thank you, and thank you everyone for attending. I'd like to begin the panel discussion by asking just a simple question. Have you ever wondered how some brokers are able to offer U.S. equities at zero commission? If you are a retail investor, if you've ever purchased a U.S. equity, or if you're a broker who's interested in offering you U.S. equities, this panel discussion, it can save and or make you money. Again, so my name is Michael Lombardo. I'm Head of Global Equities at Tradeview Markets. Just want to give a chance to my panel and my esteemed colleagues to introduce themselves.
Hi, everyone. I'm Marcela Aguillon. I'm the Deputy Director of Trading Technology at Tradeview Markets.
Hi, everyone. I'm Carlos Ladino. I am the Director of Trading Technology at Tradeview Markets.
Okay, great. So back to the question at hand. We all know in FX how zero commissions work, right? There's A book and B book. When you're dealing with U.S. equities, there's no B book. Unless you're inclined to break about a half a dozen U.S. security laws, you cannot B book your own trades. You might also think, well, a company like Robinhood, how do they do it? They sell their order flow to another company. It's more commonly referred to as payment for order flow. There's an acronym called PFOF. But how does that company that purchase that flow, how do they monetize the process? And that's what we're here to talk about. Before we dig deeper into that, there's a couple of concepts that we just kind of need to review to sort of make it all make sense. The first is MBBO. In the U.S. equities, we refer to the inside market as the national best bid, best offer. It's essentially the best or highest price that somebody's willing to pay to buy stock and the lowest offer that somebody's willing to sell stock. Very similar to FX. You just see two prices. You just see the inside market. We've integrated a number of market data systems. Carlos, Marcela, tell us a little bit about that process of integrating market data into a front-end system.
Yes, we know that market data plays a fundamental role in the technical analysis that perform the user. In our equity product, we prioritize the market data that we implement into our trading platform. And for that reason, we take a special emphasis in the latency. And we implement a tool that was developed in, if you know, a language named C++. Why we choose this language? Because they allow us have a control over the hardware, over the memory of the services, and these features give us control over is important when you want to develop real-time systems on our application. And in our tool, in our maker data, we reduce a lot the latency for the stocks.
Great.
Yeah. Well, basically, there's a difference, and it is why this is very important for us. There's a bunch of difference between the pricing from a real stock exchange and the CFDs based on these equities symbols. And basically, we wanted always to have a consistency with the market data. So always our customers can make a real trading technical analysis over the charts and have a real market data, no markups, no retransmitted data, and obviously get the less latency possible to have a good market data for customers.
And that's a very good point. So you pointed out the difference between CFDs and real equities. Obviously, when you're dealing with CFDs, quotes are completely subject to every single broker
Right.
who can implement their own
Right.
spreads. When you're dealing with real equities, though, we're talking about real spreads that come directly from the exchanges. Quotes are globally disseminated. Behind me is a system, MetaTrader 5. At Tradeview, and we all worked on this together, one of the few brokers who actually integrated real U.S. equities onto MT5. So the quotes that you see behind me, although it's not live right now, are actually disseminated and coming from the exchanges. You can notice a difference in the spreads. The spreads that you see on this screen are the same exact spreads that you would see whether you're in London, New York, anywhere in the world. So that's a key component of this.
It is yeah, exactly. It's a regulated data.
Correct.
I mean, it's not
right. It's a big commodity.
There's no interference or something like that.
So that's the first part. Second component, second concept, just to discuss. In the U.S., it's called Reg NMS, or Regulation National Market System. It was implemented in 2005 by the SEC. It basically defines order execution rules in the U.S. So a couple of components with related to this topic. The first, it's called the order protection rule. So if you are a retail trader and you want to sell stock at a particular price, and you are on that MBBO, and you're on the inside market, institutions cannot trade outside of your price. They have to take your offer first before they actually go and trade outside of your lowest offer. Same thing on the bid. So that's order protection. The second component is under Reg NMS, stocks cannot be listed in less than 1 penny increments. So whenever you see any sort of real U.S. equity, it cannot be in fractions of a penny on a level one, on what we commonly refer to as a lit market. Lit market meaning market that you are actually visible, it's on your screen. So that's Reg NMS. Number 3, in the U.S., there's something that we call dark pools. It's not necessarily relevant. It doesn't really happen too much in FX, but dark pools play a key role in the U.S. equity market structure. Dark pools are, you can think of it as a network of computers where market participants are all completely plugged into. You can't see bids and offers. You're in the dark. And what the anonymity that market participants gain access to is that they're just simply putting in bids and offers in there, hoping to get filled. Carlos, Marcela, you've built something similar. It's not necessarily, we can't call it a dark pool yet, but you built a piece of technology called Vulcan. Just tell us a little bit about that and how that sort of relates to the U.S. dark pool structure. Yeah,
definitely. Well, the first thing is that for equities, we integrated something inside MetaTrader 5. It's called gateway integration. Marcela can talk a bit about it, and then I would jump at the Vulcan.
Sure.
Yes. When we started to integrate MetaTrader 5 for stock traders, we want to a proprietary system to have full control over this and to give our user a very effective and efficient support. And for that, we compiled a native fix into our gateway, and it give us a full control over the flow of the orders. And for that, we develop a really high level application that is easy to deploy, easy to control, and is what the clients needs. And we have, like I mentioned, a full control of this, and the clients can have a really effective support from us.
Yeah, that's really important. I mean, for us, it was our first need to build our own technology, because we can obviously jump over the issues quickly and give a really fast support to the client, give a very effective support to the clients. Then we started, beside the gateway, we start to develop our own bridge technology called Vulcan, and inside Vulcan we have the system that allows us to plug in a different sort of programs, included the integration with the stocks. So what we're building is a liquidity pool similar to the dark pools, to have an aggregation system inside the Vulcan and have a lot of liquidity providers from different exchanges and combine prices and give it the best bids, the best offer.
Great. Okay, so let's continue. Another key part of this, last part, is the concept that U.S. exchanges, in order to attract investors, in order to get you to trade on their exchange, they offer you an incentive. They offer you a rebate. So when you are using limit orders and you are adding liquidity to the market, the exchanges will give you back some money. Conversely, if you are using market orders and you are removing liquidity from the market, you are going to be charged an execution fee. All right, so this goes on. There's a number of different structures across all the different exchanges and the time of trades, and it's too complicated. But the most basic one to understand is if you add liquidity, you get 0.2 of a penny back. If you remove liquidity, you are actually charged, let's say, 0.3 of a penny, and that's the basic model. So to put this into context, how does this work? And we'll use an example to illustrate this. You are a retail account, and you open up an account with Robinhood, and you say, hey, you know what? I want to buy 100 shares of Apple. And let me see. I think I should have. So you see Apple on the screen. Right now, the inside market, or the MBBO, is 190.59 by 190.60. It's a penny wide, okay? So if you are Robinhood and you send that market order, Robinhood can't go to the exchange and purchase stock at that 190.60. If they did that, they're going to incur a fee. So how the zero commission model will completely fall apart. You can't pay exchange fees and offer zero commission. So what do? They sign a deal with a wholesaler or an investment firm like a Virtu or a Citadel, and they sell their flow to these companies. It's, again, commonly referred to as PFOF, payment for order flow. How does Virtu monetize this? How are they able to monetize this? If they have to pay for this, what are they doing with that order flow? And there's two things. The first is they can internalize the flow within their own trading system, all right? And they could simply match bids and offers, all right? And take both sides of a trade. If there's somebody selling and somebody buying at that same exact time, they internalize the trade and they're able to easily profit from the trade. What more commonly happens is they create algorithms. They create routes that actually route out to all of these different dark pools in search of hidden liquidity. And this is, again, it's an intricate part of the U.S. equity market structure. Creating these algorithms, I mean, they are hiring the smartest, the brightest algorithmic programmers in the world. People like Carlos and Marcela, who are actually creating these programs. Now, you guys have created a number of different programs. What's the process involved in actually creating like an algorithm?
Well, basically, you have to understand first what is all the use cases, the requirements of the program you are creating. You need to have a very specific use case to understand what the program has to do. So after programming all the modules, we usually make a unit test for each module, then integrate them in a single program, make a whole test about this. Then we go for a UAT test for end user acceptance test, and it's a loop over because it is a never ending, you have to always be improving the program.
Right. So a lot of testing, a lot of back testing into this, forward testing using real data. Great. So to put this into context, let's bring everything together. So now Virtu just receives this order from Robinhood. You're the Robinhood trader. You want to buy 100 shares of Apple at $190.60. Virtu is bound by the rules of Reg NMS. They cannot go and sell stock to you at a higher price than what you see on that screen. It's it falls out of the regulation, so they can't do that. So what do? They create these dark pools. Well, they create these algorithms that are looking for liquidity in there. One of the most popular strategies is called a midpoint strategy. So within that 1 penny spread, these programmers have written code that will look for liquidity in between the bid and the offer. In this case, it's a half a penny wide. They already know, based on statistical modeling and whatnot, that on 80% of the time, when they employ one of these algorithms, they're going to find this hidden liquidity at the midpoint between the bid and the offer. So they will buy stock at 159.5, 159.595 exactly. They will print to you, the retail trader. They're going to sell it to you at 159.60. In complete compliance with Reg NMS. They've broken no rules because they are still within the confines of the inside market. So they're essentially making, on 100 shares, they're going to make 50 cents. And again, I'm just using numbers as an example, but they're making 50 cents on that trade. They have to pay Robinhood 15 cents. They're going to net out, let's say, 35 cents on that trade. Doesn't seem much, but when you're talking about the U.S. market and billions of shares a day, the numbers add up. And there's a reason why these companies are now worth billions and billions of dollars. I'll use Virtu, for example. Virtu famously disclosed in their prospectus when they IPO'd in 2015, out of 1,238 trading days, they had one losing day. Not days, trading days. We're talking over a period of 6 years. They did not have a losing day. And so what are the pros and cons of this? If you're a retail trader, you obviously, are you getting the best execution? And the answer is no, right? You should be getting filled at that midpoint price, and you're not. And so there's a conflict of interest here between what Robinhood, a company like Robinhood, is doing in terms of how they go about describing themselves. Can you call yourself zero commission when you're really sort of not giving them the best execution? And it ran into, they did run into a number of problems, and that conflict of interest is what's led many of the regulators to really kind of take a look at it and say, you know what, we really need to stop doing this. A proponent of this, if you are in favor of payment for order flow, it's simply that there is so much liquidity, hidden liquidity that's being created. There are so many more bids and offers. It actually narrows the spread. And so proponents of PFOF are saying, hey, you know what? We're actually doing the market a benefit by doing this, employing these strategies, because it actually keeps spreads a little bit tighter. So where are we now on PFOF? Here in the UK, it was banned. PFOF is no longer, I believe it was banned in 2012. In the EU, there was some back and forth about whether it was going to be continued or not. They made a decision to ban it. However, you still have about 2.5 years. It's going to be banned in June of 2026. In the U.S., there was some concern about whether PFOF was going to be allowed or not. And about a year ago, Gary Gensler, the head of the SEC, decided to keep it. However, it's going to be much more regulated. And they actually put forth a number of rules this past year to sort of try and keep monitoring it or regulate it a little bit more. The first rule that they implemented was the order auction rule. And basically now what they're saying is, hey, if you're a broker, you can't just cut a deal with the Virtus and the wholesalers of the world. You have to actually go out to the exchanges and you have to auction off that order. And they're trying to get a little bit more transparency. Obviously, there's a lot of pushback from some of the market participants on that particular rule. The second thing that they're doing, or at least is under consideration, is that they're removing the 1 penny increment rule. So when you see a lit in the lit market, when you see a quotation, you're going to see stocks that are no longer 1 penny wide. They're going to be in fractions of a penny. The market-making firms like Goldman Sachs, J.P. Morgan, very much against that proposal as well. The last proposal, which I think you're going to be seeing very soon, is brokers are going to have to disclose an execution score. So depending on the difference between where you get executed at your price, what you see, and the price that they actually fill the stock, they're going to create some sort of a panel or a view where you're coming up a score. They'll come up with a score, and you can now compare one broker's execution score to another. And I think that's going to be close to fruition. So again, if you are a retail trader, what can you do? Ask your broker. Ask your broker, hey, do you pay rebates on when I add liquidity? It's a legit question. It shows you that you're a little bit more of a savvy investor. If you are a broker, you should definitely get involved and maybe seek out something like Vulcan. Again, you guys are working on Vulcan, and with regards to the routing a little bit more, or?
Yeah, of course. So basically, with this liquidity pools, and to make it clear on how these firms are making money from in a certain level. Basically, with the market watch, we're seeing only two digits. So that means in the dark pool, there's more digits actually to get that midpoint. That is the whole point.
They are not bound by Reg NMS in terms of what the 1 penny increment rule.
Exactly.
It's in the dark. You can offer out stock at whatever price you want.
Exactly. So what we are doing, creating this liquidity pools that you can create custom and customize the symbols, digits, so you can get more resolution for the full price. Getting these better prices, and obviously trying to get some business to the brokers using the Vulcan bridge.
Great. That's it for our discussion. Anybody have any questions? Nope. All right. Thank you, everyone, for coming. Thank you for taking the time. I know it's late in the day here. We have a couple hours until the end of the show, so I appreciate you guys sticking it out. And again, if you guys do have any questions, please feel free. You can reach out to us directly. Thank you.
Spot
Thank you.
And spot 1. Thank you.